Hello and welcome to KYC, a brand new show at NDTV Profit. In the fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of companies they invest in. KYC, Know Your Company, is a show designed to give you, regular investors, powerful, actionable insights into the fundamentals of a single NSE-listed company every day. And today, we talk about Ceigall. Now, this is another one of those recently listed companies in the capital goods and infra space. And in fact, the focus is very much infrastructure and construction, where the company, in fact, specializes in structural work specifically. If you actually take a look at all the things that they've done in the past, they are mostly into elevated roads, flyovers, railway bridges as well. But besides that, they're also looking at overbridge tunnels, highways, expressways, as well as runways. So very much into the road sector and the segment. And even in terms of the way the revenues come through, when it comes to the breakup, well, you have a majority of your revenues coming in from road, highways, and flyovers. In fact, 83% of them coming in there. And the balance will be around tunnels. Railways and metros do, however, form another 13% of their overall revenues. So this is what the company does. We thought that it's an interesting company because it's recently listed. It's a relatively smaller company as compared to what we have been used to when it comes to companies in this particular sector. So, well, on that note, let's start off with the ratings. And for that, I'm also going to get in my colleague Anushi, who joins us to perhaps take us through the same ratings that we're going to talk about. And in the ratings, of course, we talk about the income statement, the kind of growth that we've seen, the balance sheet, cash flows, as well as shareholding, and among other factors which will be in focus. We talk about the order book positions, return ratios of the company, peer comparison, and street credentials. Anushi, welcome and thanks for joining in. Why don't you take us through how the company's growth has been over the past 3 years?
Of course. Agam, let's see how Ceigall has done in terms of its growth. We are seeing a strong trajectory in terms of revenue, around 51% of a CAGR growth in the last 3 years. Well, this is quite an impressive growth number that we are looking at. FY24, they had clocked in a revenue of 3,029 crore. And do note for the FY25 year, they are maintaining a 15 to 20% of a revenue growth guidance. If you look at EBITDA, there has been again a 48% of a CAGR growth that we are looking at. This is with FY24 number coming at 518 crore. In EBITDA, for EBITDA margins, they've maintained their EBITDA margins at 17.1%. So for FY25, though, their margin picture looks in the range of 12 to 12.5%. Coming to net profit, 38% of a CAGR growth, with FY24 revenue standing at about 304 crore. So solid trajectory that we are seeing in the last 3 years.
Right. Well, that's as far as your income statement is concerned, and it's been very strong, as Anushi's pointed out. But how is the balance sheet looking? And this is another one of their relatively stronger features when it comes to the company. So, firstly, they've seen a significant bump up in net worth. But we must remember that the company has been recently listed, which means that its balance sheet, of course, will have expanded on account of the listing. But that said, as far as its gross debt is concerned, that remains largely stable. We must also remember that because it's an infra company, it does have a relatively higher amount of working capital requirement, which means that your gross debt will remain stable. But if you consider it and compare it to the net worth, it's a very favorable debt to equity ratio. And not to forget, if you actually consider the cash balance, in that case, that ratio becomes even better because, of course, based on FY25, the first half, we're looking at a cash in bank of around about good 564 odd crores. So it's certainly an improvement in the debt to equity ratio on a net basis as well. So a pretty stable balance sheet as well in this case. But how are cash flows looking, Anushi?
Agam, you just pointed out with most of these infra companies that we speak about, there's need of higher working capital requirements. And with how the first half is panned out, there was an uptick that we've seen in terms of receivables and payables because of these kind of working capital requirements and elections also accounting for that. The cash flow from operations for the first half, you're looking at a negative figure of about 305 crore for the first half. This is in comparison with a positive 15.5 crore of a figure But do note that if we look at the last 3 years number of the cash flows, they have been on the negative side. Net cash flows, if you see, that have been at 197 crores. So investing and the other aspect has aided in this uptick that we are seeing, which makes up from what the losses in the cash flow from operations. H1 FY24, the number was at minus 15.2 crore. This was a negative number that we are looking at. So this is the overall cash flow numbers that we are looking at. But let's also address the shareholding pattern of the company as well, Agam.
Right. So Anushi recently listed. So of course, it's the promoter holding stands at around 82%. Now we must remember that as per SEBI's shareholding norms, this number of 82% eventually has to come down to 75%. The question really is that where does that balance go eventually down the line? But for now, as you can see, it's very tightly held between promoters and, well, institutions, looking at another 6% odd together, DIIs and FIIs, that leaves about 12% with the outstanding shareholders, the retail shareholders, if you like. Overall, it's a tightly held company, which is why it's a thumbs up. But as I mentioned, the only overhang in this shareholding could potentially be that eventually this 82% will have to be brought down to 75% as per SEBI shareholding norms. But overall, given the fact that it is still very tightly held, it would be a thumbs up as far as the shareholding is concerned as well. But what's the next factor on your list, Anushi?
Order book position for majority of infra companies is something that we should be watching out for, as this determines the revenue growth ahead for these companies. So if you look at the order book, that stands at about 12,153 crore. Now, if we take this into consideration of the FY24 revenue picture, we are looking at almost a 4x of a book-to-bill ratio. So this provides further medium to long term of revenue visibility for the business going forward. In terms of order inflows, they've clocked in about 2,500 crore of order inflows. So overall, a healthy picture that we are looking in terms of order book and order inflows, Agam. But let's also talk about the return ratios.
And very strong return ratios, surprisingly. We are looking at well over 30% return ratios, 33%, 33.6% precisely for FY24 on return on equity. And if you consider the return on capital employed, again for FY24, that is also above the mark of 30%, 32% to be precise. Now, a thumb rule of sorts is anything above 20 to 25% is strong, which means that leaves Ceigall India with a very strong foothold as far as these return ratios are concerned. The real question is that do these return ratios change through the course of the time? That only, of course, we will know eventually down the line, a couple of quarters down, we will have the annual numbers. But for now, it certainly is looking very, very good and very strong as far as the return ratios are concerned. Let's talk about its performance for the stock. Now, so far, since its listing, it has, in fact, the share price has declined around 10%. We can't talk much about the dividend because, firstly, it is just recently listed. Secondly, growth companies tend to usually curtail their dividend dole-outs, and which is understandable because they do need to use that capital into, well, your businesses. A lot of that could potentially be used for working capital. So wouldn't hold anything against the company if the dividend were to be less. But for now, we don't have data on that. And since listing, of course, we've seen, it come off to a certain extent. Take this conversation forward with, Mr. Bhagat Singh. Mr. Singh, good morning, and thanks so much for taking the time out. Your company, as we've been mentioning, on a very strong footing in terms of your revenues. My first question will have to do with your order inflow for the balance of this financial year. Seasonally, we do know that this particular second half is very strong for the entire sector, and that's because a lot of the awarding activity picks up during the second half and particularly the fourth quarter. But there was a concern around the conversion ratio when it comes to the company. It stands at around 1:10 or about 10%. Can you tell us about how you are expecting the second half of this financial year to turn out when it comes to your order inflow? When I'm going to admit that your order book is still very strong, and so we already have very strong visibility. But what is your assessment here?
Good morning, and thank you for inviting us here. So as far as our predictions about the market is concerned, so we are expecting a good order book to arrive at in the last quarter of this financial year. Normally, it is a trend of the industry that during the NHI order books normally gets more substantially positive for the industry during the last 2 quarters. So we are expecting that the last quarter would be we will be able to receive a significant flow of new tenders from the authority. And as you rightly mentioned, that Ceigall India Limited is basically a leading infra player. So we have a decent order book of 12,000 crore plus. We have already 14,000 crores of or new orders in pipeline, which would be yet to open. And our order book to bill ratio as on December last year was 5 plus, and still we have an order book of 3 plus. So our order to revenue conversion ratio is significantly good. Last year we closed our financials at 2,952 crores, and this year we have guided the investors with an annual growth rate of 15 to 20%, which we feel that we would be able to maintain on the sustainable and a growth basis.
Hi, Mr. Singh. This is Anushi joining in. I'll continue with the order book question, the order book discussion that we've been making. Now, there was, if you look at the first half, in terms of government activity, it was on the muted side with the elections taking place and other factors in consideration. Now in H2, there's discussion about strong capex revival from the government side. So with this, what is your assessment of the kind of order inflows that should be expected in H2? And where will this take your order book towards? And just wanted to understand on the execution part also. You've mentioned that you currently have about 15,000 crores of orders in pipeline. So if you can get, how much would that be converted as well? So if you can give an overview of all these factors.
It is needed to mention that infra growth is significant and must for any national survival, and same is India is not an exception to it. So I personally feel that the order book, which we are expecting to have a good number in the last quarter, it would be turned around more. We would be able to witness more towards metros, railway modernizations, water irrigation projects, new airports, aviation business would be on a more significant perspective. This is what I personally believe, and all these areas are a good significant revenue earning model. As far as Ceigall is concerned, so we have guided in the initial part of our year that we are expecting an inflow of 5,000 crores during this year, against which we have already received 3,774 crores of new orders from the authority during the first half. As far as the new second half is concerned, so as I mentioned that we have already bid 14,000 crores of new order, and we are planning to bid another 15 to 20,000 crore more. So until in the last quarter, we are expecting that a new order inflow of close to 5,000, 6,000 crores, which making my order book to close to 17,000 plus at the year end. And as we discussed in the earlier interactions also, that our order book is well diversified into various sectors, be it EPC, be it roads, we are into railways, we are into metros, and the new order books which have been recently received, it comprises of 2 new HAM tenders from Ayodhya, for which we are expecting an appointed date in the last quarter of this financial year, which ultimately will make my order book to revenue ratio to a significant new level.
Mr. Singh, I understand that you're a growth company, which means that there are a lot of funds will go towards investments. But over the last 3 years, what we've seen is on a net basis, the cash flows are still in the negative territory. At any point in time, can we expect the net cash flows to remain consistently in the green?
Sir, I would like to rephrase your statement. At the outset, I would like to specify that the cash flow from operations on a standalone basis is positive. This is clearly visible from the standalone financial numbers of Ceigall India Limited, which are audited and in public domain. When you examine the cash flow statements of any infra company which has HAM assets, that you will find in the initial part of the years on a negative. The reason why the cash flows are negative, that needs to be emphasized upon. So under the HAM model, whenever you work for any authority, 40% you receive during the construction period, and remaining 60% the authority pays you along with the interest during the next 15 years. So since 60% goes as a receivable in your balance sheet, so every year whenever you do more work for HAM project and you compute increase and decrease, so on account of accounting aspects, the cash flow on a consolidated basis got negative. But I feel personally the way to examine the balance sheet is when you examine the balance sheets or financials of any EPC company, that is who is executing the work, the cash flow from operation should be positive, and Ceigall has already proved it. You can examine our financials for FY 22, 23 and 24. All the cash flows are positive.
A follow-up to that, there isn't going to be a big difference between standalone and consolidated numbers. Is that right to assume?
No, see, till the time the company holds the assets, EPC assets, it may be there. But as and when the monetization of HAM assets take place, you will be getting the two benefits to the balance sheet on a consolidated basis. Number one, the sale proceeds of the HAM asset would be added to your cash and bank balance. Secondly, the total debt amount, which also parts of the cash flow statements, this goes to the buyer. So you will be having a twin positive impacts on a consolidated basis. You would be finding it on this position to be further improvised as and when the any sale of HAM assets take place in future.
Okay, Mr. Singh, now I want to understand on the income statement numbers as well. Now, for revenue guidance for FY25, you've guided for a 15 to 20% of a growth. I understand that in the last 3 years, you've been on a solid trajectory with a 50% of a CAGR, as we discussed earlier. So, considering that H1 was on the muted side with the various factors taking place over here, I want to understand that FY26, with the revival firstly happening in H2 and with more orders expected and execution taking place, what is this the number that you would be sustaining for FY26 and 27 as well?
See, we are basically a listed company and we have to follow some protocols. So on a conservative basis, we have already guided the annual growth rate of 15 to 20% in the top line. But yes, efforts are always there. We have a requisite material, financials, and other resources which forms a part of a productive ecosystem which converts the order book into revenue. We always believe that as and when the land is available, Ceigall possesses the requisite resources to convert its order book into revenue. 15 to 20% is what is the guided number on a conservative basis. Actual number depend upon year to year. So, and one more thing, apart from the revenue growth, we believe in giving consistency in our profit margins also. So our EBITDA will also remain consistent in line with the guided number.
Mr. Singh, again, a question on your debt as well, and it does seem like, considering your net worth, you're in a very comfortable position when it comes to debt. And I'm assuming, once again, that a lot of that debt is basically raised for working capital. So my question then is, one, are you in fact comfortable with your current debt levels? Because I believe that you have about 560 odd crores of cash on your books as well. This is based on the first half of this financial year. And the second question is that if you are seeking more projects, is it possible that this debt number will go up higher, or do you have plans to in fact bring it down even lower over the course of the next few quarters or years?
Okay, the answer to the first part is yes, we are very comfortable with the present debt level. We have raised 1,252 crores in the IPO, out of which 684 crores was a primary issuance, out of which 413 crore were raised from the primary market for the repayment of a debt. So the entire debt has been repaid by the company, and to that extent, you will appreciate that the internal accruals are now available for supporting the NWC and the long-term financial position. So the present debt position is company is very, very comfortable. My FY24 debt equity ratio was 0.21 only. And as far as the future, considering the further order book converting itself into revenue, we feel that the company is making its best efforts to keep the overall debt equity ratio less than 0.35.
All right. All right. So, Mr. Singh, we'll leave it at that. Thank you so much, in fact, for joining us and giving us so much more clarity with respect to your financials as well as what we can expect going forward. And now a lot of these pointers will be very important for the viewers here who are, in fact, interested in Ceigall India. So thank you so much once again for joining us here at NDTV Profit.
Thank you for inviting us for interactions. Thank you.
Yeah, so there you have it. That's the management of Ceigall India telling us about how things could potentially pan out. And as Anushi and I have been pointing out that, you know, the company at the moment with its financials in general is on a strong footing. So very quickly, let me also take you through the strengths, weaknesses, opportunities and threats. When it comes to strengths, it has a strong order book position. We've spoken about that, along with a very strong execution track record as well. And it's consistently performing financially. In terms of weaknesses, it does have a high dependence to government projects, And NHAI projects comprise of nearly 80% of the order book, so it could do well with a little bit of a diversification. And negative cash flows is something that the management has already addressed, so I'm not going to talk too much about that. But Anushi, opportunities and threats.
Of course. So now in the opportunities, the first big one is that they're constantly expanding into new territories and are on the lookout for. They plan to diversify the exposure from the current 10 states that they already have. What started from Punjab, then they've expanded to 10 states and then more. So higher order opportunities, you've pointed that out in your strengths. One should be watching out from the other states as well and for their other verticals as well. Second is the revival in the government capex for H2 onwards. We've seen the first half there was on the muted side with the factors like election taking place. So order conversion would be one of the factors that would revive in the second half for the company. Also NHAI pipeline of around 3, the company in its previous con call had pointed out that there was a 2 lakh crore of an opportunity in the BOT model, that's a build, operate, transfer model from the NHAI side, that is for the next 3 to 5 years. So any kind of successful bids and conversions from this is going to aid the revenue growth of the company as well. But on the threat side, Agam, let's also speak about the competition. We've pointed out there were several competitors that are present there. And with the company's conversion ratio of 8 to 10%, this could be one of the points that we should be watching out for, whether they are able to successfully convert their bids into orders as well of their ongoing projects as we speak. So conversion ratio and delays in competition and even the execution side, even if there's threats of current projects, if there's any kind of delays which pertain to their upcoming ongoing projects, that could also be affect the business operations of the company. So this is the overall what we are looking for in opportunities and threats for the company.
Also a wrap on this edition of KYC, but lots more lined up on the other side. Stay tuned to NDTV Profit.